Hey everybody, this is Jim Keene with the Cattle Hedgers Almanac. Wanted to discuss the detailed look at the strategy summary and give you an idea of how to read this summary. I think it is turning out to be very good. I'm proud of it, and it's just kind of puts everything in perspective as to what's going on and how my strategy, my hedge strategy, is all put together in one nice little package so you can see. So let's start out looking at the different uh, areas of the summary. So the first part of the strategy summary is the break-evens. All good hedging plans are tell you need to do your diligence in figuring out where you're at with feeding cattle, and the same way with this strategy. And what the strategy summary tells you in this first section. Oh, I didn't want arrow. um, so the first part of this strategy summary goes over our break-evens, and these are just general break-evens. The first one is this guy right here, and this is a general break-even for cattle that are ready to slaughter, and this is based off of the CME feeder steer index. So I use about 800 pounds, the current index price, and then if I were to feed cattle for 180 days, this is my break-even price, what it would take to feed cattle out and make money. So the next part is the local break-even. I'm here in Nebraska, closest to Huss Livestock Auction in Kearney, and that is our local break-even. And I tried to get around 800 pounds. Sometimes it's more, sometimes it's a little less. And in this case, this week, 833 pound animals sold for $1.48. If I were to feed them to 1,350 pounds at 85 cents cost of gain, this is what my break even would be if I were to buy locally. So it's usually quite a bit more than the index price, but gives you a general idea of what a break even were to be if I fed cattle out buying those 833 pound animals. Now, cow calf guy, these are for fed cattle. A cow calf guy can also look at these break evens and determine, wow, it's $1.24, and cash is right now $1.11. Of course, these are 180 days out. Board prices are nowhere near $1.24. So a cow calf guy can look at this and say, well, my calves have pretty good value, or they're overvalued. Next part of my summary I go over is my profit loss. And the first little bit here is my profit for unhedged cattle. This is if I bought feeder index prices and tried to hedge them at current, about 180 days ago, and tried to sell them at current 5-area index cash prices. So you can see right now we're $19 a head loss. Over to the right is the current CME feeder cattle index prices, fed 180 days out, and if I were trying to hedge them at today's April futures. So I try to get close to whatever futures months is in 180 days from now. It's a little more than April futures, but I have posted April futures. This is just current prices right now. This does not say, yeah, the high for April futures was $1.20 and now it's $1.15. This is currently what April futures, if I were to hedge April futures, this was what it'd get me, and it would provide me a $4 loss for if I bought CME index prices today, sold them on April futures today, I would be locking in a $4 loss. And I color code these, so if they happen to be positive or profitable, they turn green. If not, they will turn red. And again, a cow-calf guy can, these are for fed cattle prices, and a cow-calf guy can look at those and say, if they're deep in the red, you know, feedlots are not going to want to pay for my calves if they're deep into the red. Next up is slaughter and demand. First category we have is slaughter. So here's our weekly totals in slaughter. How many head were estimated that they slaughtered? A week ago change. This was as of the Thanksgiving weekend. So naturally we have 3 days less slaughtering than a normal week. So it's going to be 101,000 head decline. And what it does compared to the same week last year. And then I post the weights and the change per week and the change of last year. And I do that with both live and dressed weights. Next is our pace, our slaughter pace. This shows you as of that Thanksgiving week, we had slaughtered in 2020 29.293 million head. Last year we were on pace at 30,349,000 head. Next is our comp score. 82.2% grading is the percentage of the animal that goes for our choice and select load counts, and comprehensive purchases is how many animals were purchased that week for slaughter. Moving into the demand side, we have our choice and select box prices. This is the retail value that the slaughterhouses sell to grocery stores. So choice last week was $2.43 per box load, or I guess a pound. Select was $2.19. It is, then I had post the weekly changes in choice and select. And the spread between the choice and select tells you the quality of the meat. So if a higher spread would tell us that we have less choice meat being sold and more select meat, then more select, and a narrower spread would be the opposite. We have a lot more choice and a lot less select. Continuing on with the box beef prices, I also post the total load count. So you can, when this is charted out, and I'll show you, By the total number of loads, you can kind of guess seasonally what direction the choice and select is going to go. And if prices are right, you're going to see these load counts really go up. Prices are higher, you're going to see these load counts go down. And so now you can get a general view of what the grocery store demand is. Next up is the box live equivalent spread. And I'm trying to figure out how best to calculate packer margins. This is not a gross packer margin, but it tells you the spread between what the packers are getting in retail versus what they're giving you in the producer, what they're bidding for the live animal. So a higher spread tells you that the packers are making generally more money than they're giving you, the producer, and a lower spread tells you that the value that they're giving the producer is very good compared to what they're getting in retail. So you'd assume that a higher spread means the packers are making a lot of money and they will continue to buy cattle for slaughter. A lower spread means that they'll probably start trying to pressure prices and not slaughter as much. And how I determine all this is basically charts and spreadsheets. Here's the chart on general break-even for cattle ready for slaughter in 180 days. And here is your current slaughter-ready cattle, profit or loss for unhedged cattle. And it shows a little bit of a loss, about a cent loss per head, based off of a 117.5 break-even. Here's a look at box beef load counts and prices. And you can see how our load counts have been going down and are naturally, because of supply and demand, our prices are going to go up. So our prices have been the best we've seen since the pandemic crazy. So you can expect that our comprehensive load count in box beef is going to start creeping up, and seasonally this price will start coming down, because what's happening is the grocery stores loaded up for the holidays, which brought demand higher, prices higher, and now that they're filled up, you can start seeing this price start to drop. And you should also see our load counts go up as prices drop. I also track the comprehensive sales live head and weighted live price. So this tells you the volume of head that were sold and the price that they were sold. Same in dressed head and weighted price, which is generally a lot more than your live price. So it has better value. And then total purchase volume compared to dressed and live head, and then the total. Next up is kind of the nuts and bolts of it all. And I start out with what I call the price barometer. So what I do is I break the feeder market up into 6 months increments. March is September 1st through March 1st. Chart out the 10-year averages, the high and low and the average. And then I use this figure, which is my fundamental factor, which was the fundamental factor going into September 1st. of this year and applying that percentage to the 10-year averages. So what the barometer is the 10-year average corrected for fundamentals. So I'm telling you that current fundamentals in March feeders is between basically 154 and 131 futures. What you can tell by just looking at that part is if prices are above 154, you know that we're getting a little overvalued. If prices are below 131, we're a little bit undervalued. Looking at nothing else. So the range for March feeders right now is between 154 and 131. Then what I do is I use a scale for hedges called the percent to hedge. This is a general reference of where you should be at if I were to buying hedge-wise. So if I were to be buying calves, I would want to be 100% hedged below 131. If I were a cow-calf producer, I would want to be 50% hedged at 142.5 futures. What I post on the summary is the best price that I could have gotten or hedged between September 1st and March 1st. So March feeders from September 1st till now got below 131. Therefore, I should be 100% hedged at or below 131. From September 1st till now, March feeders has given me a price of 142.5, and the scale is at 50%. So right here is my percent to hedge scales for March feeders on the sell side and the buy side. And this is the scale. So if we were above 154 and I was cow-calf operator, I would want to look at being 100% hedged above 154. And this is just strictly looking at price barometer and what a seasonal prices would do. And if I was a feedlot and I wanted to buy calves, I would want to be 100% hedged at 131 or below. If the market was, say, 140.2, I'd want to be in that 62% bought. Right now for the week, March feeders closed at 139.425. If I had nothing going on hedge-wise and I wanted to do something, 139 is in the range between these two, so let's just say 35%. So on the sell side, if I was a cow-calf guy, I would want to be right now approximately 35% hedged. If I was a feedlot needing to buy calves, I would want to be between 76 and 62% hedged. So say 70% bought at this price range. Looking at nothing else, just the price barometer. Over next, we kind of get into a little bit of technicals right here. And the first technical I look at is the 2151 zone, and that's basically just support and resistance area. If we're where prices tend to gravitate towards. So if we're in an uptrend and we're getting overbought and it needs to correct, it usually corrects down into this zone. If we're in a downtrend, getting oversold and it needs to correct higher, it tends to rally into this 2151 zone. I just use these two technical indicators. There are thousands out there. And for me, I know I need to keep it simple. And so those two are my these two are my go-to technical indicators. I don't really pay much attention to anything else. My plan revolves around these two indicators when I consider hedges. Cow oscillator is my indicator. It's a lot like RSI in a way. It's got a little different formula that it figures, and it's going to tell you a bottoming or topping, or if you're bearish or bullish patterns. It's also very good in divergence patterns. So if we're going up and we're making new highs and the oscillator doesn't make new highs, that's bearish divergence, and it's very good at determining where those areas are. And here's a look at January feeders, the red being 21 and the green line being 51. And you can see it has a high degree of success. So here we are, we're in a rally, we come down, pop through the zone, need to rally back because we were oversold here, rallied into the zone, and then kept coming. Here we're going up, went up through the zone, got overbought, declined back into the zone, and then continued up higher. So it's just support and resistance. I use this because a guy can look at a chart and come up with 1,000 different support and resistance areas. Not smart enough to figure out where they all are. I'm just using the zone as a good place of where my support and resistance areas are. That's basically all I use. Don't use support and resistance lines. I just use the zone. And here is my cow oscillator. The red being a fast oscillator and the slow being the slow oscillator. And wherever they cross is kind of what you need to look out for. And then also I use overbought being 75 and above, oversold being 25 and below. So I would want to look at where they cross, and especially if they cross above those areas. So right here is a good sell because we're above 75 and it crossed. Right here is a good buy. We're below 25 and it crossed. That was a really good signal. And it's going to bounce around. Right now it gave us a bottoming pattern right there, telling us that the market could be bullish coming up. Also on the oscillator, it's hard to see, but this yellow dotted line is also the futures price, also on the chart. So it kind of tells you the levels where the futures are. Next up is my cash right here. So on the left side, we have what the current CME feeder index is doing. Closed out Friday at 139.18. The 5-year average is 149.036. And I will post my comments. So cash is in a downtrend. We want a bear spread. And I kind of tell you what the week did and what to expect if the downtrend or uptrend breaks. And I will tell you what a 5-year seasonal will do in cash. So here's a look at my feeder cash index price chart. And you can see at, I think, mid-April, we started an uptrend. And we broke it right here, telling us that cash could get weaker and that on cow-calf guys, the sellers need to start looking at increasing your percent to hedge. So right now, I'm using this line right here, and that's a downtrend. And our dashed blue line here is the 5-year seasonal average. And the yellow dotted line here is what prices did in 2019. So when I say right now we are in a cash down scenario, it's because our cash is grinding lower. And this week we actually rallied a little bit into this downtrend. So I told you on the summary that if this line were to break, that would mean see if I can bring it up. So a break of this trend, of this downtrend, would tell us to decrease our percent to hedge on the sell side and an increase percent to hedge on the buy side. So what you're going to do is you'll look at this price barometer and determine what you need to do hedge-wise and what percentage you need to be hedge-wise if that cash market did take out that downtrend, or if it continues, what you need to do as far as how much hedge you should be at, or what level of a hedge you should be at. So if we consider just cash and we go back to the price barometer, and I was a cow-calf guy, and cash downtrend does get taken out at this level, we know right now we should be about 35% hedged. Well, the downtrend gets taken out. So, and I'm a seller of calves, and it looks like prices are going to be strong. I may want to be less hedged than what my price barometer is telling me to be. So I would, and there's an infinite number of ways you can do it. You can buy puts, just get out of the hedges, whatever you want. I'm not a broker. But that is something that you should discuss with your hedge broker. On the buy side, if I was a feedlot and it looked like prices were going to go up because the downtrend is now taken out, I'm in between 76 and 62%. Maybe I want to be 90 or 100% hedged because now it looks like cash is going to get stronger. And that is just based on a cash signal. So if I was just identified my cash risk alone, that's how I would play just the cash end of it. I also should note that if the zone, so the 21 goes above the 51, I color code this green. If the 21 goes below 51 in bearish posture, I highlight it in red, and the oscillator is kind of the same. If it's bullish, it's green. If it's bearish, it's red. Next up, I identify our basis risk, which is right here. And again, I will tell you what the current basis is doing against March futures and what our 5-year average is. And I will put that on a chart and tell you that basis is weakening to sideways. What you should do in a basis weakening scenario is to sell cash if you can versus futures, and the 5-year seasonal, what the 5-year seasonal pattern does. And here's a look at my basis chart for March futures. You can see we had an uptrend going, which was basis strengthening, telling us that cash was going higher than futures, telling us if we wanted to do the hedge that we would actually be gaining equity if when basis is going up and still hedging, our equity is still going up. It broke that uptrend right there, sending us into a down or a basis weakening telling us that we should be selling cash and not futures because of the equity drain. And so right now we're in a downtrend. It took out this downtrend, and now we are kind of doing a sideways pattern. And I expect that we will be just kind of bouncing around and kind of going lower through the remainder of the contract. So that's kind of to be expected. So in this case, I say because of the 5-year seasonals is lower, but it did take out our downtrend. So basis is sideways to weaker because of the seasonal pattern. So that's how I identify what basis is doing. So the next step in the strategy is I will tell you what to do hedge-wise according to our two risks, cash risk and basis risk. And I use what I call my hedge decision. And here is my hedge decision. So right now we know cash is down, which tells us to bear spread the futures, use front months to hedge. And we have a basis weakening. So I want to be aggressive with my hedges. I want to short futures or calls or short calls and long puts. And also with the cow, I want to increase my percent to hedge every time the cow tops, because I have a high degree of success rate with my short hedges in a cash down basis weakening scenario. So what I'll do is I'll post that in a cash down and basis weakening tells us to be aggressive with sell hedges and have no position on or protect with options on the buy side. Basically, I'm telling you because the prices are weaker and going down on the buy side, we don't want to get in the way of that. If we are comfortable with that price level because of break-evens or whatnot, you're going to protect it with options instead of outright futures. Then I don't normally do this, but I will also kind of explain what's going on and how I see things. In this case, people are, I don't know if they're getting bullish or optimistic because prices did come up. I believe speculators are trading a bullish placement number, and if you paint the entire picture and not just one little part of the cattle on feed, it kind of tells more of a bearish scenario going forward. And then I will tell you to increase your percent to hedge every time the cow tops on the sell side. And if you're a buyer, every time the cow tops in a cash down basis weakening, you're going to want to decrease your percent to hedge. And again, you're just going to use that percent to hedge table as your reference point. So that's how you should read this strategy summary. I do the same exact thing in the live cattle, only the price barometer. I will use 3 months increments twice. So I'll start 6 months out, but between the time frame in live cattle would be October, September, and August is a completely different price barometer and percent to hedge scale. So in this case, my best price that I could have gotten in February live futures was 40% hedged at 115.4. And I will go through again the cash risk, your live basis risk, and what to do in futures. And of course, I'll have my zone posted and what the cow oscillator is doing right now, which right now it's bottoming. And that's it. That is the strategy summary for right now. So if you have any questions about it, please email me, call me, whatever. If there's something that you can see that I need improvement on, I'm always looking at improving. Don't be bashful about it. Let me know what you like about it, what you don't like about it, and any improvements. So that's the strategy summary. I hope that gave you kind of a clear picture of how I use it and how you can use it as a producer. And again, any questions, comments, let me know. Now go out there and make me some steak. See ya.